Let me start with a number that should stop you in your tracks. On January 29th of this year, silver hit an all-time high of $121.67 per ounce. Today, as I'm recording this, it is trading at around $72. That is a 40% collapse in less than 2 months. 40%. And yet right now, in the past few sessions, silver has bounced nearly 6% off its lows. So the question everyone watching this channel is asking is simple. Is this the bottom? Is this the moment where the pain stops and the recovery begins? Or is this just a relief rally, the kind that sucks people in right before another leg down? Curious? I'm going to give you a real, data-driven answer in the next 10 minutes. We are going to look at exactly what caused this bounce, what the technicals are telling us right now, what the fundamental picture looks like for the rest of 2026, and most importantly, what could happen next and which direction this market is most likely to move. Stay with me, because this is not a simple story. There are powerful forces pulling silver in opposite directions, and you need to understand both sides before you make any decision. Let's go back to the beginning, because the context here is everything. On February 28th, the United States and Israel launched military strikes on Iran. That one event set off a chain reaction that has been absolutely brutal for silver. You might think, war breaks out, investors get scared, they pile into safe haven assets like gold and silver, and that is exactly what happened at first. Silver surged above $93 on that initial war premium. Analysts were getting excited, talking about a return to triple digits within days. And then, within 48 hours, it gave every single cent of that back and then some. Here is why this conflict has been so different from what people expected. The US-Iran war did not just create geopolitical uncertainty, it directly threatened the global oil supply. Iran controls access to the Strait of Hormuz, one of the most critical shipping choke points on Earth. When that became a real risk, oil prices spiked above $112 a barrel. And that oil spike did something very specific to the market. It made the US dollar extremely strong, because oil is priced in dollars globally. A strong dollar is one of the single biggest headwinds for silver and gold. It makes them more expensive for buyers outside the US and simultaneously raises real yields, which means investors would rather hold dollar-denominated assets that pay interest than hold silver, which pays nothing. On top of that, the Federal Reserve, which had been expected to cut rates twice in 2026, suddenly found itself staring down the barrel of a potential inflationary spiral driven by energy prices. The market rapidly repriced rate expectations, signaling only one cut for the rest of the year. Higher for longer rates, stronger dollar, oil fears. Silver went from $93 to a near $61 low in a matter of weeks. That is not a pullback. That is a meltdown. So what changed this week? On Tuesday and Wednesday, reports emerged that the Trump administration had formally sent Iran a 15-point plan aimed at ending the conflict. This is significant. The market had been pricing in a prolonged war with no off-ramp. The existence of a structured peace proposal, even if Iran hasn't fully accepted it, suggests there is at least a framework for a diplomatic resolution. Oil prices pulled back from their highs on that news, and when oil fell, the dollar softened slightly, and that gave silver the room it needed to bounce. As of right now, XAG USD is trading around $72 to $73, up roughly 2 to 6% depending on which session you are measuring. That bounce happened fast and it happened sharply, but here is the part that should give you pause. Iran has already pushed back against the US proposal. As of this recording, Iran's response to the 15-point plan has been skeptical, with officials calling elements of it unacceptable. So the optimism that drove this rally? It is already starting to fade. Silver paused its intraday advance on Wednesday as those conflicting signals came through. The relief rally found a ceiling almost as quickly as it found a floor. Let's talk about what the chart is telling us, because the technicals here are important. The drop below $73.16 was described by analysts as a major setback. That level represented both the 200-day moving average and a long-term upward trend line that had been in place for months. Once price broke below it, sellers took control. Right now, silver is attempting to reclaim that level. But it hasn't done it convincingly yet. The 50-day moving average is all the way up at $80.02. That's how far silver has fallen. For any kind of meaningful technical recovery, price needs to get back above 73 first, then work its way toward 80. Until that happens, the path of least resistance is still technically to the downside. The critical support zone that analysts are now watching is $61. That was the low hit earlier this week, and it was a key support level going back months. If silver breaks below 61 and holds there, the next major support is around $54. So the range you need to hold in your head right now is this: $61 is the floor, 73 is the near-term hurdle, and 80 is where the picture starts to look meaningfully better. Now here is where it gets interesting, and where the case for silver becomes genuinely compelling, despite everything I just told you. Because underneath all this short-term chaos, the fundamental story for silver has not changed at all. In fact, it has gotten stronger. The Silver Institute is reporting that 2026 will be the sixth consecutive year in which global demand exceeds global supply. The projected shortfall this year is 67 million ounces. Mine production is forecast to increase by about 1% to around 820 million ounces, a decade high. But even with that increase, it is not enough to close the gap. Total supply hits 1.05 billion ounces and it still falls short. Demand is being driven by physical investment, which is forecast to surge 20% to 227 million ounces, a three-year high. Industrial demand from AI data centers, 5G networks, and electric vehicles remains structurally strong. High-performance computing infrastructure and EV power systems need silver regardless of what the spot price is doing, so those industries keep drawing down already tight above-ground stockpiles even at these depressed price levels. Meanwhile, retail buyers in India and China are treating the $68 to $72 zone as a rare buying opportunity. Physical demand in those markets has surged as the price dropped. That is a key distinction between the paper market, where institutional investors are selling silver to cover margin calls and reduce exposure to risk assets, and the physical market, where real buyers are quietly accumulating. That divergence between paper and physical demand is one of the classic signs that a bottom may be forming. When the people who actually use the metal are buying more of it at lower prices, that tends to put a floor under the market over time. Let's talk about what the major institutions are saying, because the spread of forecasts for silver in 2026 is almost comically wide, and it tells you everything about how divided the smart money is right now. JPMorgan has a 2026 average target of $81 per ounce. With silver currently at 72, that implies roughly a 12% gain from current levels over the course of the year. UBS is more aggressive, seeing a potential peak of $100 mid-year before settling back to 85. The LBMA consensus, that is the London Bullion Market Association, the benchmark body for precious metals pricing, sits at $79.57 as their annual average forecast. On the bearish end, TD Securities has a target of just $44.25, and on the very bullish end, some of the major silver advocacy analysts have targets north of $175. That is a wider forecast range than almost any other commodity or asset class, and it reflects the genuine uncertainty in this market right now. Everyone agrees on the fundamentals: supply deficits, investment demand, industrial use. Where they disagree, violently, is on the macro. What does the dollar do? What do real yields do? What does the Fed do? And most importantly, what happens in the Middle East over the next 2 weeks? Which brings us to the part of this video you have been waiting for. What happens next? I'm going to give you 3 scenarios, ranked by my assessment of their probability, based on everything we know as of today. The most likely near-term scenario is continued volatility with a slow, grinding upward bias, provided the diplomatic process stays alive. If Iran continues to engage with the U.S. 15-point plan, even imperfectly, oil stays below $110 a barrel. The dollar softens slightly. The Fed's rate path remains unchanged at 2 cuts for the year. In this environment, silver can continue recovering toward the $75 to $80 zone over the next 4 to 6 weeks. This is the relief rally extending scenario. It is not the start of a new bull market. It is the worst of the selling pressure exhausting itself while fundamental buyers step in at these levels. Probability, roughly 50%. The second scenario carries the most downside risk for anyone holding silver right now. That is a complete breakdown in diplomatic talks, or worse, new military escalation. March 28th is the critical date. That is when the Trump administration's stated postponement of new strikes on Iranian energy infrastructure expires. If that deadline passes without progress, and new military action targets Iranian oil fields or port facilities near the Strait of Hormuz, Brent crude could spike back above $115 almost immediately. That would strengthen the dollar sharply, pressure real yields higher, and silver would likely retest that $61 low. And if 61 breaks cleanly, the next stop is $54. That would mean another 20 to 25% downside from current levels. This is the scenario where the 6% bounce we have seen this week turns out to be nothing more than a dead cat bounce before the next leg lower. Probability, 30%. The third scenario is the one the bulls are praying for, a genuine ceasefire agreement. Not a proposal, not a framework, but an actual deal with Iran that takes military escalation off the table. If that happens, oil collapses back toward $80 or below within days. The dollar weakens sharply. Rate cut expectations come flooding back. And silver, which has already sold off 40% from its all-time high and is sitting on top of a massive structural supply deficit, could rally violently and quickly. In this scenario, the $80 to $95 range becomes realistic within weeks. JPMorgan's $81 annual average target starts to look conservative rather than optimistic. This is the scenario that every silver bull is watching for, and it is not crazy. It is just not certain. Probability, 20%, but with the biggest potential reward of the three. So, is this the bottom? Here is my honest assessment after working through all of this data. On the fundamental side, the case for silver being at or very near a major bottom is genuinely strong. 6 consecutive years of supply deficits. Physical buying surging at these prices in the world's 2 largest physical markets. Investment demand at a 3-year high. A price that is 40% below an all-time high set less than 2 months ago. If you are a long-term investor, this looks like the kind of setup that, in hindsight, will look obvious. The metal is cheap relative to where it was, and the demand story has not changed. But on the technical and macro side, the picture is far murkier. Silver has not yet convincingly reclaimed the key $73 level. The dollar is still strong, the Fed is not cutting, and the geopolitical situation has at least 2 more weeks of serious headline risk before the March 28th deadline passes. A real bottom is always confirmed by price action, not just by fundamentals. And right now, price has not confirmed anything. We have a bounce. We do not yet have a reversal. The $73 level is the line in the sand. Watch it closely. If silver closes above 73 with real volume and holds that level for 2 or 3 sessions, that is the first genuine signal that the worst may be behind us. If it fails at 73 and rolls back toward 65 or lower, be very careful. The next support level is a long way down. If you are already holding silver, this is not the moment to panic and sell at these prices. The structural story is entirely intact. But if you are thinking about buying aggressively on this dip, be honest with yourself about the risk you are taking on. Size your position accordingly, because a failed diplomatic process before March 28th could take silver back to 61 or below before any sustainable recovery begins. If you found this analysis useful, hit the like button and subscribe. I cover silver, gold, macro trends, and the geopolitical forces that move commodity markets every single week. Drop a comment below and tell me, do you think this 6% bounce is the real bottom, or do you think there is more pain ahead first? I read every single one, and I will see you in the next video.